Folks, welcome back to Market Call. I'm Guy Adami. I'm joined by Dan Nathan. It's 5 p.m. on the East Coast, and I am fired up because the next 2 weeks, you're going to catch us live at 5 p.m. here on Open Exchange, YouTube, and check this out, Twitter. We'll be breaking down the biggest moves of the day and what we're watching ahead of tomorrow and basically the week to come. Today's episode is brought to you by FactSet. Financial data and analytics powered by Tomorrow, and of course Open Exchange, because they manage virtual meetings that matter for the top companies around the world. And by the way, Dan, all our meetings matter, but here at 5 o'clock, it matters a lot.
Yeah, it matters. Hey, listen, it feels like we never left Market Call, Guy. We were just doing this a few hours ago, but it's fun. Hey, listen, you know what? We love doing fast money, but they are dark for the next couple weeks because of the Olympics. And I enjoy the Olympics, but I'm still in market mode at 5 o'clock. So we're going to do this thing, man. We're going to talk about it. Let's get right into it. Today was a really interesting day. It really felt like the market was kind of trying to find its footing a little bit. We had a lot of volatility, single stock volatility last week, a lot of volatility in and around some economic data. We're going to talk about that in a little bit. But man, look at this 2-day chart of the S&P 500. What a late day dump, Guy. That's the sort of price action that you often see maybe before some big event that's coming out that people know about, but we're maybe got some kind of late jitters or so. What do you see when you see action like that, when a market's trying to stabilize after a very volatile period, right? What do you make of that sort of action in the last hour of the day?
Well, it's a new paradigm, and I'm going to say it is a new paradigm because, we were in this world where every dip needed to be bought for literally the last decade or so, and that was the correct mantra. It's no longer the case, in my opinion. Now, I think rallies need to be sold. By the way, Liz Young talks about that as well during her work with SoFi, and I'm with her on this one, and I think that's what you saw today. Typically on days like today where you had the market rally around noon, 12:30, 1 o'clock, you would see a huge follow through the upside, and we'd be scratching our heads at 5 o'clock trying to explain what happened. Today makes sense to me because I think that's what's happened. The market has shifted, and now I think people are looking to sell rallies, and I think the late day sell-off speaks to that. A longer-term chart probably says a better story as well, Dan, and we've looked at this for a while now. I mean, we are traded down below that trend line, which you drew. That's a great long-term trend line that we've broken. The 200-day moving average has been violated. We traded back up to that line of support and resistance, and we are seemingly failing. We're right at the 200-day now. This, to me, is a line of demarcation, Dan. As you say, X marks the spot.
Yeah, I mean, listen, pretty interesting setup here. We have been talking on Market Call and on Fast Money for months about the concentration in a handful of names. I think it was 7 names, and you know what they're all these mega cap tech stocks have made up nearly 25% of the S&P 500. That's half a dozen stocks making up a quarter of the weight of an index of 50 stocks. And we know it was much more pronounced in the NASDAQ 100 here. And what was interesting about the earnings last week in particular was that the big ones, Microsoft and Apple and Alphabet, were thought to have saved that market. But then we got, we were in a free fall for all intents and purposes when you think about it. And then we got some disappointing news out of Facebook. The thing that stuck out to me, Guy, today, other than the late day dump, before the late day dump, was the price action in 2 names, okay? And they're going to be very contrary to each other. And they both had massive gaps on earnings over the last week or so. The first one is Alphabet. We just talked about that. That quarter was great, and the guidance was great. And it really kind of bucked, I think, a lot of sentiment in the space at the time here. And look at that gap that it had. It gapped up to a new all-time high last week. And a lot of people were like, put that together with Microsoft and Apple from the week before, and that's it. We're done. Those big names hold in. Well, look at the fact that it's filled in that entire gap. What does that say to you about people who are initially very excited about the Google quarter and guidance, but a few days later, it looks like a different story?
They should have been excited about it because it's a remarkable quarter. And quite frankly, when they reported on the show, I said, this is the quarter that should take this stock to a new trading range north of 3,200. By the way, I think there's some street calls out there for north of 3,500 or so. And that made sense in terms of the release. But the fact, to your point, that we traded up to the prior highs we saw in basically November and early December and seemingly failed is no bueno, as they say. Now that 200-day moving average, which probably comes in around 2,700 or thereabouts, is right in the crosshairs. We violated it once, we traded through it, went back to a prior all-time high, seemingly failed, and now here we are. I think this is a huge chart to watch. Sometimes good news, bad price action, that's what you're seeing now. that sort of tells the tale for a change in direction. And I think that's what we're on the precipice of now.
Yeah, it really could be. I mean, that's not a great sign. That's not what you wanted to see here by any means. And I'll just say this for a lot of people who look at Alphabet and say, wow, it's a really cheap stock. Their sales are expected to grow 18% this year. That's after a 40%, 42% growth in 2021, trading about 24 times, with low single digits expected earnings growth. It's really not that cheap in an environment, guy, where tech is being repriced and we're seeing interest rates go higher. Going to talk about that in a couple minutes. The other one that really caught my eye on the flip side of this was Facebook. That one-day gap last week of 27% was astounding. I think it was one of the biggest one-day declines ever in a stock, nearly $200 billion in market cap. But here's the thing, that stock closed down 5% today. I mean, just kind of shocking when you think about it. And that chart's just broken. Is there a big gap to be filled? Yes, at some point, not anytime soon. And if you look at a 5-year chart of this Facebook and you see, draw a line from that gap in 2018, that was the last time they had a major fundamental hiccup with a guy down here. That stock went down for months and months. Obviously, if you look at the high it made right before the pandemic, that was something out of their control. But you see that support where it comes in. I'm just curious your take on the Facebook action 3 days after that massive gap.
Look, I thought we were going to stop, obviously, right at those lows. If you go back December, October of 2021, that's where I thought we would stop. Well, we went right through that. Didn't even really stop. You didn't even have a speed bump there. What I'll tell you, and you were right to bring this up, we saw the same action basically in June of 2000, I want to say 18 or so, into literally Christmas Eve when the stock, which was making an all-time high of 225, traded down about 105 on Christmas Eve and then a subsequent bounce. This is the exact same thing in terms of time duration and to a certain extent in terms of percentage move. But here we are. You drew the green line, Dan. Prior resistance becomes support in the form of exactly that, this 225 level. A close through there, and I don't know what to tell you. Then you're probably talking about a stock that's going to trade sub 200. And a lot of people then be saying, what's wrong with Facebook? And oh, by the way, what's wrong with the broader market? The quarter was a disaster. And by the way, on a NASDAQ tape that had traded really well, Facebook topped out, I want to say, Dan, and you know this, in early September of last year and has been trading poorly ever since.
Yeah, well, you say what it doesn't mean for the broad market. I think the thing that you're going to have to watch now with Alphabet filling in that gap, how does Microsoft sitting right on $300 here, how does that trade in a choppy market over the next couple of weeks? And the other one is Apple. Apple had what I think by all accounts was a very good quarter and good guidance. I mean, even though it wasn't, stellar guidance, that sort of thing, we're still in a very uncertain, supply chain environment, an uncertain consumer spending environment. And that Apple went exactly where you thought it would be, to the high 150s, the prior breakout level. It's sitting about 10% above that. So Microsoft and Apple, keep a close eye on, Guy Adami. But, you got to get bored talking about tech. We do that an awful lot here. You're kind of into some more old school sort of things that catch your eye on days like today.
Yeah, and a lot of people now starting to talk about it for good reason, by the way. But the first thing I've been watching, obviously, has been crude oil, which, you called this one, Dan. I want to say late summer into the fall. You said, you know what, you don't really trust it. And that proved to be correct because you saw a pretty precipitous drop from about 85 down to 61 post-Thanksgiving. And that move, you're talking about probably a 35% move. Well, we're back on the horse now and clearly through. The move to the downside in the fall was for two reasons. One, the Omicron virus, which was announced the day after Thanksgiving when we all heard about it in earnest, and that subsequent or right around the same time SPR release. Those were the two things that knocked it down. Well, the SPR release was short-sighted in my opinion, and we seem to be through Omicron, and we'll talk about some of the reasons why in a second in terms of some of these travel stocks, and here we are. The fundamental story for crude is still intact, and I think it's going to trade triple digits. I thought it would happen by the end of last year. It didn't, but it's pretty close now, Dan Nathan, in terms of the crude oil. Now we'll talk about XLE in a second, but I just want to hear your thoughts on this.
Well, listen, you had a heck of a call on this thing. I mean, your call has really been for, a more longer term time horizon of what the supply demand dynamics look like in a kind of, an environment that are kind of more easy to track. And I think you said Delta and Omicron. These were things that were really hard to kind of figure out. In both instances right before that, I think a lot of people were like, all systems go here on the reopening, and we're seeing China slow down a little bit. That could be, one of the things I'll just tell you. We know that China has been easing a little bit. I don't know, man. Carter Braxton Worth, he was on with us on Market Call earlier today. He had a chart showing kind of it getting pretty extended here, calling for a bit of a pullback. I'll just say this: if you look at those peak to trough declines over the last year, the declines have been getting bigger and bigger, guy. And here we are now. We've just kind of on this runaway breakout here. Listen, things that go to 90 usually go to 100. You kind of, you've seen that enough in the markets. That's not particularly scientific, but there's something in the equities that track crude, the large integrateds, and the oil services that are, I think, giving you more confidence about that $100 call.
Well, it's the XLE, and the XLE is basically 45% comprised of ExxonMobil and Chevron, and then throw ConocoPhillips in there, or vice versa with Conoco and Chevron. It doesn't matter. Those three names are 50% of the XLE effectively. And you see the move we've had. I mean, it's been a pretty stunning move. Now, we are up against pretty significant resistance. I agree. That line you drew is exactly right. That's where we broke down from in the beginning of late 2018, beginning of 19. I still think it has some, no pun intended, gas in the tank, and I think we're going to take out 80 because I do believe that people are probably still not believing in the underlying equities. The commodity clearly is in play. I think people come to the realization, wait a second, maybe vis-a-vis the broader market and the commodity, some of these underlying equities are just they're just too cheap at these levels, and I agree. I've talked about Schlumberger and Halliburton on valuation seemingly for the last year, and now that's playing out. And you can say the same thing with these big cap integrated names, specifically the three that I mentioned.
Yeah, listen, I guess I trust throughout my career, Chevron and Exxon delivering a little less than others. But, you just mentioned, Schlumberger and Hal. Look at that OIH, that chart of the oil services ETF. And you've been all over that one. I mean, that one, though, if you look at it on a long-term basis, looks very different than the XLE. I mean, the XLE has made back some serious ground over the last few years, where the OIH really has not, right? And I know that you suspect that there's probably some good beta in that sector, which is why you probably like that. I know that Halliburton's been a name that you came into this year. I think it was one of your top picks or so. But it also is kind of banging around at levels that it's found technical resistance at over the last, year or so.
Yeah, and tomorrow we'll bring up an OIH chart, but that's basically comprised of three names: Halliburton, Schlumberger, and Baker Hughes. But to your point, they're finally starting to catch up, but there's a lot of room left in terms of the OIH, where we've been historically and where we are now. I would submit there's still significant room to the upside. I would say anywhere from 18 to 25%, Dan. But I know there's some things this week that you're watching that I'm watching as well.
First of all, Guy, you're just a real pro. I was talking to a chart that didn't exist. And you know how seamlessly you just said, you know what, we're going to bring that with us tomorrow. So we're going to take a look at, that was a little preview of what we're going to do tomorrow in the OIH when we're back here for Market Call. All right, let's hit some of these things, because really what's going on this week is a little extension of what we saw last week. We have some big earnings. I mean, like, you thought you were through them. I think we're at least 50% through the S&P 500 earnings. And then we also have that CPI data on Thursday, which will kind of be like a main event, especially when you consider the market reaction to that really hot jobs number from January. But let's hit some of these earnings first, because I think it's kind of interesting. Like, when I looked at my board today, I saw a lot of these travel related names just absolutely screaming, and you know what they are. They're the airlines, the jets, and the cruise lines and that sort of thing. But a name that you've been kind of following pretty closely over the, I think it made it into one of your acronyms. Isn't that what you call it? An acronym for fast money?
Is that the thing where you put letters together and spell word? If that is an acronym, then yes, the E in the Hope trade was Expedia, Dan Nathan. You're spot on.
Right. Well, they report later this week, and I think that's going to be really interesting, because this is a stock, on Thursday reports, that is trading very near all-time highs. And we know that this was what Tom Lee, our friend over at Fundstrat, was calling one of the epicenter stocks, the hardest hit stocks from this pandemic here. What's your take on this one? Because it's forming a nice little pennant formation, or a flag formation, I think you would call it. And, with that event coming up, if they're able to guide ahead, and listen, I don't think anyone's looking at this current quarter, and I don't think a stock like this is going to be penalized for what they just announced. If they're able to look forward and say, we see trends coming back online, you see this thing breaking out?
Yes, I do. And I think that's exactly what they're going to say. I obviously don't know, but listen, the way the stock has traded over the last couple months suggests exactly that. This stock is looking past the variance and saying, you know what, we probably, in terms of just the virus, we probably have clear sailing from back basically the second half of this year on. And I happen to agree with that. By the way, you saw some of the mask mandates being taken off. So you could start to see what people are looking at. You also saw Spirit Airlines today, that announcement with, I think it was Frontier. That to me speaks to an industry that, you know what, is starting to get geared up for what they think is ahead. So I absolutely think this is a stock that's going to break out to the upside. As you said, they report on Thursday. One of the names that a lot of people aren't talking about, but this is telling the story to me of not necessarily the recovery, but this recovery in names that people are getting out there and traveling again, specifically the airlines and obviously all the ancillary plays.
Yeah, well, that would certainly help your $100 a barrel crude call if that goes smoother than over the last year or so. So no more hiccups. For all of us, let's kind of pray for no more variants and move beyond this thing in 2022. The other name that's been on your radar, guy, is I think it's the D in your Dawn trade. That's your other acronym, which was Disney. And you got into this one at the right time here. I think you had that gap from the last quarter. Disappointing Disney Plus subs. I'll let you speak to that. I know you're very focused on that. It is new Boba Fett one, and it's just a dud, guy. I'm just telling you, it's not gonna be on your watch list, just so you know. But we have this 2-year chart, and it's pretty fascinating. With the stock just around 140, guy, it is literally at the dead midpoint of the 2-year range. Talk to me about Disney. Is the worst news out of it? We know we have those earnings Wednesday after the close are going to be important. Give it to me.
Look, I think last year when the stock was trading, obviously it's tad north of 200. I think it really got ahead of itself in terms of valuation, and we talked about that. We have different guys that come on all the time and talk about the lost leader that Disney Plus is, and I agree with that. And I also think they sort of threw in the towel with that last earnings release. But I think to me right now, all the bad news is in the name. And I actually can make a compelling case at $145 for Disney on valuation. I think people have flocked out of it for a number of reasons, not least of which those Disney Plus numbers last quarter, and obviously what's been going on with the virus. But I think that's in the rearview mirror now. So if Disney Plus is just okay, which is all it needs to be, I think they're going to talk about the second half of this year being gangbusters for Disney and all the ancillary products that they have. So, yes, Disney is the D in my Dawn trade, Dan.
All right, but Guy, I got to ask you this, okay? And you know what? Listen, if we are really in a new regime, as you mentioned, and if we are really, on the precipice of something bigger. And, one of the things, and we'll talk more about this week, we talked about the gaps in some of these stocks. I really think what went on was Snapchat up 60% in one day on Friday, and Amazon up 13%, close to $200 billion in market cap, and that Netflix gap and the PayPal gap the prior week. I really think something's going on here. And I'll just say this. One of the reasons I'd say be very careful into this Disney quarter, when you go back and you look at private market tops, back in 07 and 08 and back in the .com, it was some of those prior market leaders that had consecutive disappointments. And so I don't see anything, at least if you're focused on Disney Plus, out of that Netflix guide that would lead me to be too bullish about what they're going to have to say going forward. So you and I talk about it all the time. You can actually start dipping your toe into a position without having a full position. I just don't know if buying this stock, if you're not in it and you have that mindset before the report, makes a whole heck of a lot of sense, because maybe it's up 5, 8, 9% or something like that. You're only going to have a small position, right? But if they disappoint, the stock's going to like 130.
Yeah, 125 probably, to be honest with you, which was a prior all-time high way back when. You're right. And if they do disappoint 2 quarters in a row, I don't think the market's going to take any prisoners here. But to your point about Netflix, I think a lot of that now has manifested itself in that little flush in Disney. You sort of think about 133 or so over the last couple of weeks. So I happen to think it's in the stock. You think there's some more room potentially. That's what makes markets, and that's why we do these things. But just looking at this chart, it's done a lot of work on the downside. I think the setup is okay in earnings this week.
All right. Well, listen, let's talk about a big number. We flagged it just a little bit ago that's coming out here. It's the CPI. It's that inflation print for January that's coming out Thursday before the opening. I just really quickly want to get your take on that jobs data. It really surprised a lot of people for January. It came in really, really hot. They revised December up. it basically made the Fed at least look good for the moment of why they are being aggressive as far as their tightening, poise here. Just curious on the jobs and what you think it might mean for the CPI and how the rate market might take it.
Yeah, that's a great point. I mean, the jobs number surprised a lot of people. If you watch some of the cable news shows last week into that jobs number, some of them were outright giddy, talking about the potential for a negative jobs number. Obviously, that didn't come to fruition. And just in terms of the numbers, forget about politics. I mean, you're talking about some record numbers over the last couple of releases, which augurs well, I guess, going forward. It also means the Fed's way behind. And I think the move from 182 in the 10-year, basically in a straight line to 191, speaks to exactly that. And we're looking at a Disney chart, but we should take a look at 10-year yields because this, to me, tells the story, Dan. Now, it's been volatile. You had a great call from the spring into the summer. You thought yields would go back down to about 115. I think that got to a 111 or so. And it's been a little up and down the way back to 2%. I think we're getting to 2%, and it could happen on the back of a CPI number that I think is going to come in north of 7.3%. That's the whisper number that I'm hearing.
Yeah, well, I'll just say this. I mean, like if you take out 10-year U.S. Treasury yield on that chart, and you and I have been talking about this a little bit, it's held that uptrend. It just got above that prior high from, last year or so. And it looks like a really good looking flag formation breaking out. But when you zoom out a little bit, Guy, and I want to get your kind of take on this on a 5-year chart, 2% was a big level when it broke down back in early 2020 here. Here we are getting back up there, and you think we've gone all the way in the 10-year from what will likely be the generational low, right, below 50 basis points to near 2%. What is it going to take to get that yield ripping higher? And if we had a 20-year chart of the U.S. Treasury, it's upper left, bottom right. You maybe get to about 3% or so before you get that long-term trend line. But the last time the 10-year was at 3%, it was in late 2018, and the stock market went down 20% in a straight line, and we know what the Fed had to do.
No question about it. And I think you've pointed out that, yeah, rates can continue to go higher. But as you just said, we're in a very long-term downtrend in terms of yields. And that's exactly right. So even if we were to get up to 2, even 2.25, that downtrend would be intact. What does it say at 2%? Well, it really depends on what the 2-year is going to do. Not to get too wonky here. I'm not looking to make people's eyes glaze over. But that 10-year yield spread right now is about 61 basis points or so. Now, I've said for a while that I thought 2s, 10s would go to about 30 basis points, and I thought it would be in the way of 1.5 in the 2-year, 1.8 in the 10-year. And you know what? I'll actually sort of stand by that because I could find a scenario here, Dan, where we do get up to 2%, market sells off, flight to quality in the form of 10-year yields with 2-year yields rising. So to me, this is important, but in the context of a 2-10-year spread, that's really what I'm looking at right now.
Yeah, it makes sense. I mean, listen, I think at some point in 2022, and you made this point, Guy, I think investors are going to get comfortable with higher yields. And we knew they couldn't stay at 0 for a long time. So if the Fed if they weren't too late and they're not hiking into a recession and the rest of the globe comes back online, that sort of thing, I mean, then they will have been doing the right thing because we could have had crazy inflation the world over, trade wars. I mean, literally could have been a big mess. So let's see. Let's hope the stock market can deal with it here. I don't think we're done just yet. But Guy, when you think about rising inflation and you think of macro assets going haywire, there's one shiny metal that is near and dear to your heart, big guy. Come on, you got to give it to me. You sucked me into gold a couple weeks ago. You and Danny Moses on our podcast On the Tape here. And I'm looking at this thing, and Carter was talking about it earlier on Market Call. Something's got to give here, buddy. What's going on?
Great movie with Jack Nicholson. Something's got to give. I'm a huge Jack fan, as you know, by the way. Look, what do I think is going to happen on the back of this? I think this pennant's going to break, and I think it's going to break to the upside. Now, if you don't have an idea, if you're on the fence on this one, that's fine. Let the chart be your guide. But if you're asking me, I think it's going to basically reconcile itself to the upside move that we last saw, I think, in the summer of 2020. And I actually think we're going to blow through that. The environment is ripe for gold to do well. Now, the obvious question is, well, yeah, it's been that way for quite some time, especially we're going to look at Bitcoin in a second. Bitcoin getting cut in half, one would have thought that gold would have rallied significantly on the back of that. It didn't happen. But to me, it's a bit of and I hate to say this term, bit of a coiled spring. I think it's going to sort of, again, it's going to resolve itself with the break of this pennant to the upside, Dan. I'm sure you have other thoughts. And again, that's what makes markets.
Well, I'll just say that no, I don't. In some ways, I was looking a couple weeks ago for like some cheap vol in the options market to play some kind of volatility as far as risk assets are concerned. And option prices, option premiums in the GLD are really cheap. They're generally pretty cheap, but you look at that lack of volatility in this tightening range, and if you say to yourself, if you do have a strong directional view, if you think up, playing with calls or call spreads is one way to do it. And that's the way I kind of have been focused on this a little bit. But you mentioned Bitcoin before,
Well,
Guy.
and before we get to, I'm sorry, Dan, I don't mean to cut you off, but we don't have this chart. We'll show it tomorrow. But on a day when the market's sort of nowhere in terms of the broader market, Newmont Mining, on a day where gold didn't do all that hell of a lot, was up 4% today. Just something to watch. Sometimes those equities in the form of the miners can lead the commodity. I think that's what you might be seeing at least today. So have that on your radar screen as well.
No, that's a great point. Let's look at some of those tomorrow. We should also look at the GDX, which is the miners ETF too, which trades at a nice little beta to that of gold. Let's look at Bitcoin really quickly. And part of the narrative for Bitcoin was that it's basically digital gold. And for a while, when gold wasn't going anywhere, and you mentioned those highs in 2020, it's kind of interesting. That was the summer of 2020, and gold got creamed from those highs. And you know what started rallying a whole heck of a lot? Bitcoin did, which was really interesting. And my view at the time was like, all right, if you're my generation or below, notice how I left you out there, big guy. You might be inclined if you're looking for like some sort of inflation hedge. And at the time, interestingly, inflation expectations were not really high, guy, despite monetary and fiscal policy coming out the yin yang, all over the place. But that's why gold originally moved higher for fear of that. And then it got creamed. And then Bitcoin took off and had this epic move from like 10,000 to like 60,000. And to me, that seemed like a pretty convenient narrative. Well, it's been pretty volatile. It's at 250% plus peak to trough declines in just the last year. Look how sharp this one was. I really thought maybe we'd see 30,000 in a test of the last summer's lows. But look, over the weekend and it ended today, just had this sharp rip of that downtrend. Let's see if we can get through that 50-day moving average. I wouldn't be a buyer if it can't get below that, or excuse me, it can't get above that. You might see a retest of those recent lows.
Well, in the words of Roger Daltrey, people try to put us down. You're making fun, of course, my generation, Dan, but I'll say this, exactly that. If you had said to me, Bitcoin's going to get more than cut in half, from 67,000 down to 33,000 is where we bottomed out, what would happen to gold? I say gold would be north of $2,000 easy and maybe approaching 2,500. It didn't happen. All right. I thought it would get down to 31,000, the lows we saw over the summer. It didn't happen. We're back up almost to the 200-day moving average. But if you see, for you technicians out there, that 200-day moving average is starting to slope lower, which suggests to me a change in trend. So what I think is going to happen here, Dan, is we're going to go up, touch it, fail, and take a run at the 30,000 level that we last saw basically in the summer of 2021, excuse me.
It's funny, we spent some time talking about the levels, and you and I don't know jack about the kind of fundamentals of Bitcoin. Our friend BK, Brian Kelly, is the guy there. But, one of the things that's really interesting is that that there's futures that trade on Bitcoin. There's a lot of over-the-counter products that trade on Bitcoin, also in the derivatives market. So a lot of those strikes, a lot of those levels, the stops and such are informed by the technicals. So, to us, that seems like a good way to look at it. So there's my take on Bitcoin there.
No, I think it's fair. Listen, I'm not going to speak to the fundamentals. I can't, but we like to sort of chart things, and Bitcoin actually charts pretty well. I mean, if you're a trader and just looked at that and didn't know what it was, you'd say this is a really interesting commodity or security or stock, and it does trade well, and it's volatile, which, as you say all the time, is not a flaw, it's a characteristic. We'll see. But it's going to be interesting to see what does knock it down. It's fascinating to me that now Bitcoin's in this paradigm where the Fed's trying to be responsible, which really is the first time in the 7 or 8 years that Bitcoin has really been viable that we've seen that. I think one of the reasons Bitcoin rose to the level it is because of the fear of central banks running amok. Now you have central banks, at least in the short term, Dan Nathan, trying to get their act together. Quick thoughts on that.
Yeah, matter of fact. And then obviously there's that kind of regulatory overhang. Gary Gensler at the SEC is supposedly somebody who was like kind of friendly to the Bitcoin community, seemed a bit hostile in this first year in the job. We will see, big guy.
Yeah, we will see. And you know what, Dan? We're going to see you tomorrow. Hope you folks have enjoyed the 5 p.m. version of Market Call. Thanks to our sponsors, FactSet and open exchange. If you like what you saw, and we hope you do, tune in again tomorrow at 5. We'll be here all week, as they say. Try the veal, best in the city. And by the way, Dan, check out Market Call Macro tomorrow morning at 11 a.m., big guy. I'll see you then.
All right. See you then, guy.